Well, here we are at the end of 2025, so that means it's time for our wrap of the year video. And 2025 was a year defined by policy shocks, geopolitical risk and strong divergence across asset classes. From renewed trade wars to record-breaking equity and commodity moves, markets were repeatedly forced to reprice macro assumptions. So let's have a look and recall some of the most critical events that had an impact across FX, equities and commodities. And we're going to start with the FX market and the dominant macro forces. Currency pairs were highly volatile throughout the year as economic uncertainty and political risk dominated price action. Persistent recession fears, weak and uneven macro data, contradictory monetary policy signals, and rising geopolitical tension triggered sharp and often rapid currency moves. On top of that, we had the trade wars returning to the forefront of pretty much everything. So after Donald Trump was inaugurated as the 47th president on the 20th of January, trade policy once again became a major source of volatility in financial markets. Remember, we would seem to be talking about it for months on end. Renewed rhetoric from Donald Trump and the rollout of new US tariffs on multiple trading partners weighed on global risk sentiment and increased uncertainty around growth and supply chains. The US dollar faced enormous pressure, losing approximately 11% by the beginning of July. At the same time, the euro against the US dollar and the Great British Pound against the US dollar reached highs last seen several years ago. Now, trade-sensitive currencies, particularly the Chinese yuan, the Canadian dollar and the Japanese yen and emerging market FX experienced heightened volatility for an extended period of time. Now, monetary policy added another layer of complexity. The divergence in monetary approaches amongst the largest economies was one of the major triggers of significant price fluctuations. In September, the Federal Reserve shifted from restrictive policy to rate cuts. Now, that marked a clear turning point. Narrowing yield differentials reduced support for the US dollar and renewed interest in those higher yielding currencies. And we've also had quite a lot of US fiscal uncertainty. I think that's fair to say. Now, US fiscal policy has been a source of volatility, particularly in the back half of the year. The October-November government shutdown did not materially weaken the US dollar, but disrupted economic data releases, particularly those of a macroeconomic nature. Resulting information gap amplified price reactions. Once the data publication resumed, increasing short-term FX volatility and market uncertainty returned. So we know it's been a pretty interesting year with a lot of factors in the FX markets. Looking into 2026, currency markets are likely to remain highly reactive to trade policy developments and, of course, central bank communication. Now, according to many analysts, many economies will either stop cutting interest rates or will cut them at a slower price in 2026, so that the interest rate difference may have an even stronger impact. Also, relative growth differentials and risk sentiment are expected to be the dominant drivers of FX trends as we go into that new year. Okay, and now we're going to turn our attention to the stock market. Now, US equities experienced sharp volatility earlier in the year. In April 2025, the implementation of broad tariffs triggered a significant sell-off, marking the largest trade policy-driven decline since the COVID crash of 2020. Now, despite that, equities recovered strongly. Expectations of easier monetary policy and resilient corporate earnings pushed major indices to record levels by the end of the year. Now, the AI boom continued to dominate market performance. Artificial intelligence has remained one of the most important drivers of equity market performance this year. Again, we've spoken about it a lot. And it's a small group of mega cap tech and semiconductor companies accounted for a disproportionate share of index gains. AI-linked stocks contributed more than 40% of the total S&P 500 performance, with some semiconductor firms reporting revenue growth above 50% year on year. Now, at the same time, the S&P 500 is trading near 30 times earnings. That's way above the long-term average of around 15 to 20. A high price earnings ratio indicates that investors have high expectations for future earnings growth. But of course, it can also signal that the market is overvalued. Nvidia has reached a market capitalization of $4 trillion, with its shares representing roughly 7% of the S&P 500. That's certainly intensifying concerns around concentration risk and sustainability. So we know it's been an interesting year and we know where the main focus has been. Now, heading into 2026, of course, equity returns are likely to be a little bit more selective. Markets may remain supported by easing monetary policy, but elevated valuations, suggest lower tolerance for negative surprises. Certainly, future uptrends are expected to depend more on a larger number of companies delivering earnings growth rather than on investors paying higher valuations for existing profits that we're already seeing. So it could well be a choppy year, and certainly I think a lot of people would like to see a little bit more diversification in terms of the amount of companies involved in the growth. Okay, and to finish up our wrap of 2025, let's turn to commodities. Now, precious metals are among the strongest performers of the year. Gold surged by over 63% year to date, while silver climbed by over 120%, setting all-time highs. Now, the rally was driven by falling real yields, sustained central bank purchases, geopolitical risk, and fiscal uncertainty. Both retail and institutional demand increased, reinforcing gold's role as a so-called hedge and or safe haven. Energy markets, on the other hand, told a bit of a different story. Crude oil prices were driven primarily by geopolitics and supply risk. Obviously, we had and still have the Russia-Ukraine conflict, Middle East tensions, OPEC plus production decisions, and concerns over potential disruptions kept volatility elevated in the oil markets. Now, as a result, prices ended the year lower, with WTI down approximately 21% and Brent down around 14%. So a pretty choppy year in the commodity markets, I think that's fair to say. Looking ahead to 2026, gold and silver are likely to remain sensitive to real yields, central bank buying, and geopolitical risks. Oil markets, meanwhile, are expected to stay volatile, with price direction dependent on the balance between global demand growth and supply from major producers. So, to sum up, 2025 reinforced a key market lesson. Policy decisions and geopolitical dynamics play a central role across all asset classes. As we move into 2026, volatility probably will not fade. For market participants, adaptability, disciplined risk management, and cross-asset awareness are expected to remain critical in navigating the year ahead. Well, that's pretty much it for 2025. And as we look ahead into 2026, we wish you all the best for your trading in the incoming new year. And we thank you for trading with us and being part of the FX Open community. Have a great start to 2026. Bye for now.